There's a saying that two of the most reliable patterns in investing are that stocks outperform bonds and low priced value beats higher price growth. Lately, stocks have held up their end of the bargain versus bonds, but value stocks have been lagging. However, that may change here soon enough. So, let's take a look. The legendary investor Bill Gross recently said that investors should choose value stocks over growth stocks in the near future. Gross said that the outperformance of the technology companies and other growth stocks are linked to real interest rates, which have declined over the recent years. Gross also said that value investors know that over time a stock's price is significantly influenced by real rates, not so much by nominal rates. And nominal rates incorporate an outlook for inflation or deflation. He also said the key reason behind growth of stocks like Apple and Microsoft compared to value stocks lie in the close links between their performance and inflation protected securities. As such, value stocks versus growth stocks should be an investor's preference in the near term. And as this chart here shows, history clearly indicates that value, as measured by the FAMA French US Value Index, has beaten growth by 12.8% versus 9.7% on the FAMA French US Growth Index, and that's on an annual basis. It may be hard to see with this chart here, but the blue line represents the value index, and it clearly has outperformed the green line, which is the growth index. Contrary to the long-term history, every decade or so growth stocks can have the upper hand. Recently, growth stocks have outperformed value by 16% a year versus 7.5% for value. Part of that reason is that growth stocks have tremendous surges, but also have meaningful declines. As this chart shows, growth stocks can outperform value for a period, but that period appears to be nearing an end. After the dot-com bubble burst in the year 2000, large cap growth stocks took a long time to recover, while value stocks easily outperformed, particularly the small caps. But the trend goes well beyond that period. The growth index, as measured over 10-year periods, has outperformed the U.S. value index only 7% of the time since 1927. And when that has happened, value goes on to beat growth over the following decade. And that is just about where we are. So not only is now a bad time to pile into growth stocks and give up on value, it looks like a rotation from growth to value may be in the works. And if that happens, don't get stuck chasing growth at the expense of value. And so for today, that's ChewDog Charts. Thank you.